Federal Reserve, inflation has been so high, less money in their savings accounts, less money in their investing accounts. Alright, what's up guys? Welcome to another video. We're going to talk about Silicon Valley Bank, SVB, that collapsed on Friday. It's the largest collapse in a bank in the US since Washington Mutual in 2008. So we're going to talk about how it happened and what effects this will have on other banks and the economy in general. So kind of the short version of what happened is that they didn't really take into account inflation. They didn't consider it strongly enough. And then once interest rates had to come up, they basically just ran out of money and they went bankrupt. So as far as the, nice. As far as the longer version goes, so if you look at the start of 2020, they had about 60 billion deposits, $60 billion in deposits in the bank. Versus in 2022, started 2022, so 2 years later, they had about $200 billion in deposits. So a part of this is because after the pandemic and everything, there was a lot of money that just, was put into the economy for various reasons. And it ended up with a lot of people, a lot of tech companies just had a lot of extra money sitting around. And you can see this with the larger tech companies. They hired tons of people that eventually now they've fired some of those people again, due to things being more expensive and everything. But anyways, so if you look at the amount of money that was then going into SVB, it was a very significant raise in that money. And so basically the way that money is generated in a bank, obviously they make some money off of interest and all this stuff, but though it's not like they're going to have all the money just sitting there in the bank. They actually, so they're required to have a little portion of it kind of on deck. So they, if people take their money out of the bank, then they have some money. So there's a certain amount they need for that. But besides that, they will invest it in different ways. So they could lend it out to other people, or they could buy bonds and stocks. And so that's what SVB did. They bought a lot of U.S. treasuries. They also bought a lot of it's something that's called like very safe assets, so mortgage-backed securities. And then along with the U.S. Treasury bonds, they made a lot of money on that from 2020 until the end of 2021. So they had, I think they had about $27 billion in it in 2020, and then that had increased to, about $100 billion in a year, or a little over a year. So they had $128 billion in that in the end of 2021. So within, they had a ton of money, right? But the problem then is, with inflation, the interest rates have to come up, because otherwise, inflation is just gonna run crazy. So, talked about that a little bit before. But so what that really means is that, so say you buy a bond, right? And you get 3% yield on that bond. And then, which, whatever, it's 3%, you're kind of, it's a very, considered a safe asset. But then all of a sudden, the interest rates go up. And now the government is offering these new bonds that give a higher yield. And so then it's basically creating a situation where no one is in the market for the bond that you currently have. Because why would they go and get this 3% yield when they can just go get a brand new bond for, say, 3.5% or 4%, 4.5%. So in that way, then all of a sudden there's no one left. There's no one that wants to buy that bond at all. And so obviously the bank wants to, you know, they want to keep some of their money, so they're then going to have to sell their bond at a discount and kind of just make sure they don't lose too much. And if this happens enough, you know, people will catch on to it. People that have money invested in, or money deposited into the bank, they'll see like, oh, like maybe SVBs don't really know what they're doing here. Maybe they'll just run out of money, which is what happened, because when you have a lot of people realizing this, what's going on, starting to take out their money from SVB, then you get to a certain point. Oh, this guy's, oh, nice. So you get to a certain point where people are taking out more money than SVB currently has, right? And so they have to then sell these bonds at a discounted rate, and you could get to the point where you could get to the point where if you look at the initial deposits that everyone had in the bank, and you now look at the money that the bank has left after selling all these bonds at a discount. So if they now have less money from selling those bonds than what they started with, and people are taking out their money, then people are actually trying to take out more money than the bank has, and so the bank just goes bankrupt, which is what happened here. And the biggest thing here is that SVB did not consider inflation long term. And, you know, maybe they were affected, like most of us, maybe they were affected by, you know, the news and everyone in the government, financial experts, pretty much everyone's saying that, like, yeah, inflation's not going to be for that long. No worries. Just, you know, just send it. It'll be fine. Well, it wasn't fine, and we kind of see the consequences here now. So they just didn't account for it, didn't think twice about it, and that's why they're bankrupt now. As far as if we look at other banks, what this means, kind of hard to tell. It depends on the bank you're looking at. So we have some banks that are in similar situations as SVB. Don't really know where to put that, but okay. So, for instance, First Republic fell a lot on Monday, so today. I think it was like 60-70%, because they have, I guess people have looked into it and they have a similar situation going on. Oh, teammate. But for most banks that are, especially the larger ones, you know, JP Morgan, Bank of America, these larger banks are not going to end up in the same situation, because there's a lot of stuff that'll happen here. Obviously, people that take the money out of SVB and these other banks, you know, they're going to put it somewhere. They're not just going to stick it in their mattress. So there will be banks that will have enough money and that also are a little more, I would say, financially, I don't know, oriented. They know what's happening a little more, at least, hopefully. And yeah, so you won't have this happening to every single bank, but you could have it happen to a lot of the smaller banks. That was horrible. Okay, so another thing that comes with this is the Federal Reserve will now be forced, they're kind of in between, right? So they want to raise the interest rate to fight inflation, but now if they keep raising it, you know, they don't want more banks to end up in the situation that Silicon Valley Bank ended up in. So they can't do that. They're probably going to end with either not increasing it at all or increasing it less than they said last week. And it's a sticky situation for everyone. It's honestly, at the end of the day, it's kind of the Federal Reserve's fault, along with people that have been talking about interest rates not coming up or inflation not being as bad. That's kind of a quick rundown on SVB and that whole situation. So if you like this video, subscribe to my channel, and I'll try to keep up with more news as they come out. And yeah, I hope you like the video. Thanks for watching.